where is it going? It's probably going to 100, then 150, then 200,000. In what period? I don't know. 5 years, 10 years, but it's going there. And the reason is because every time you see all of this stuff happening, it just reminds you that, wow, our leaders are not as trustworthy and reliable as they used to be. And so just in case, we really do need to have some kind of, insurance we can keep under our pillow that gives us some access to an uncorrelated hedge. This is now the beginning of the new fiscal year for the entire mutual fund complex. So that's trillions of dollars that have to get deployed, because even though you pay them a very small fee per year, you're not paying them to hold cash. You're paying them to make decisions and own assets. And then, as you said, Friedberg, the last part of this is now you introduce rate cuts, and that's a real accelerant. Now, more than likely, I think what that means is that markets are set up to do pretty well, equity markets specifically. What is all of this saying? I think what it's kind of saying is inflation is very much in the rearview mirror. Rates are going to get cut by the middle part of the year. The economy looks like it's going to be a soft landing. That is actually very beneficial for the sitting president. It's also good for equities. It's good for us. So it's really interesting, actually. I think we've had a fundamental kind of now change.
Welcome back to Money 101. Renowned tech investor Chamath Palihapitiya predicts Bitcoin's trajectory, $100,000, then $200,000, ultimately reaching $1 million per coin in the next 2 decades. Palihapitiya, a former Facebook executive and Silicon Valley figure, was an early Bitcoin investor, acquiring 5% of the total supply with an average buy price near $100 in 2012. In his recent All-In podcast episode, he discussed the macro environment, suggesting a favorable outlook for assets like growth stocks, Bitcoin, and crypto due to a potential soft landing by the Fed. Stick around for Chamath's latest Bitcoin price predictions. For timely crypto updates, subscribe to the channel. Now let's hear Chamath's latest outlook.
I did a little tea leaf reading on macro if you guys wanted. I have some charts. I'm going to just give you a little rundown of, because I went and look, we used to talk about these things when we were doing a lot of forecasting going into this cycle. But so here's like a couple of really interesting observations. So the first one is, when you look at this M2 money supply, look how much it's actually shrunk. Now, why that's interesting to me is that you have these two forces that are opposing each other. One is we have these huge deficits, so we're technically still, frankly, issuing a lot of money, right? But then on the other side, we have QT, so when debt rolls off, we're not reissuing it. And the balance of that is still a really constructive thing, where now you can see that, M2 has materially started to shrink. And I think that that's a really positive thing, because now what that does, it combats inflation in a good way. Unfortunately for all of us, it hurts financial assets, which is not so good. I think we've all felt that pain, but the reality is that that's been working. So then, Nick, if you go to the second chart, so what you see now is like we are in a really decent place with inflation. And if you think about what's going to happen over the next 6 months, it's mostly in the bag. And meaning, we talked about this before, but there's a lag effect on a handful of components, specifically rents, which when you roll them into this inflation rate, you're going to see it really, really turn over very quickly, right? So we know that inflation is falling. It's going to fall even more. The second thing, Nick, the third chart here, is you can see that now validated in these 10-year break-evens. Remember, this was the chart we used to look at when we were like, holy mackerel, something's going to break. In November of 21, I think we probably should have just sold everything we had in November 21. We didn't do it, but the point is now we know. And what you see here is the 10-year break-evens are also telling us, okay, guys, we're going to be in a pretty decent place. And so I think the setup is basically the following. There's less money in the system. That's a positive. Nick, if you show the last chart, there's more money on the sidelines. And this is just a picture of, look at the amount of money in money market funds. 6 trillion and growing. So that's a really positive sign, which is that money will need to find a home.
Once rates drop.
No, even just now, because you're gonna be in a situation where, and I'll get to this in a second, but companies are now starting to perform because they've been able to rebaseline against very, very lowered expectations.
Right. And money managers have to do their job and deploy capital.
And that's something we mentioned, I think, last week, but this is now the beginning of the new fiscal year for the entire mutual fund complex. So that's trillions of dollars that have to get deployed, because even though you pay them a very small fee per year, you're not paying them to hold cash. You're paying them to make decisions and own assets. And then, as you said, Friedberg, the last part of this is now you introduce rate cuts, and that's a real accelerant. Now, more than likely, I think what that means is that markets are set up to do pretty well, equity markets specifically. And so I went and I said, well, how can we see some data that proves that this is happening? And what's amazing is if you look at the performance of what I would call the most risk-adjusted seeking companies, so those are tech businesses that have been absolutely hammered, what you see in the last month is they have gone just nuclear. Adyen up 30% in a matter of a week. DoorDash is up, 25-30% in a matter of a week. Datadog up 30% in a matter of a week. These are the businesses that were just completely decimated. So what is all of this saying? I think what it's kind of saying is inflation is very much in the rearview mirror. Rates are going to get cut by the middle part of the year. The economy looks like it's going to be a soft landing. That is actually very beneficial for the sitting president. It's also good for equities. It's good for us. So it's really interesting, actually. I think we've had a fundamental kind of now change. I mean, can you play the clip in 2012 and 13 when it was at 200 and everybody was laughing at me on CNBC every time I would talk about Bitcoin? Where is it going? It's probably going to 100, then 150, then 200,000. In what period? I don't know. 5 years, 10 years, but it's going there. And the reason is because every time you see all of this stuff happening, it just reminds you that, wow, our leaders are not as trustworthy and reliable as they used to be. And so just in case, we really do need to have some kind of, insurance we can keep under our pillow that gives us some access to an uncorrelated hedge. And it's going to eventually transition to something much more important. But for right now, you're just getting all these data points that prove this thing. It's just the fabric of society is frayed. And until we figure out how to make it better, it's time to just have a little schmuck insurance on the side. And everybody's running in. It's just an incredible thing. I could never have imagined it.
Coin.
It is out of control. Like, look, let's
talk Bitcoin?
Let's talk Bitcoin. 2012, I was introduced to it. I started to accumulate. 2013, I wrote an article. And
so hold on, just so we know and can feel bad about ourselves, you're accumulating it at what price?
Well, my dollar cost average is around 100 and something.
And you've held it, everything you've bought?
Well, at one point, myself and I was introduced to it by a person. I asked him if I could disclose his name. He said no. But he, myself, and another person, all three of us relatively well known in the Valley, we started. At one point, we owned almost 5% of the entire float. In 2013, we've sold, they've sold, et cetera, et cetera. I wish we had kept it all. We didn't. It's fine. But then I wrote an article, and I said, you know what? There's so much asymmetric upside here. This is a thing that either goes to, at the time I said, roughly the value of gold. And at the time, it was about $100 a coin. And so there's very little downside. There's all this asymmetric upside. I said, take 1% of your net worth and buy this schmuck insurance. And it's a schmuck insurance in this kind of very elegant, beautiful way.
I missed the schmuck insurance.
That was at $100, though. What would I actually started hearing from people that I know very well who don't often invest, who are now asking me if this is the time to invest.
Buy the schmuck insurance now.
Here's the thing. This is now a confidence game, right? There is no real utility in this. This is a fantastic, fundamental hedge and store of value against autocratic regimes and banking infrastructure that we know is corrosive to how the world needs to work properly. You cannot have central banks infinitely printing currency. You cannot have folks with, misguided and misdirected monetary and fiscal policy. No. So here's what I would say. The same way that I said in 2013, put 1% of your net worth into Bitcoin, I will put myself out there today. I think this thing is $100,000 a coin, probably in the next 3 to 4 years. And I think it is, in the next 20 years, $1 million a coin. So there you have it. What I'm saying is you could buy the S&P 500 index, buy 99% of that. So if you have $100 to invest, what I'm saying is...
Put $1.
Put $1. And the reason that $1 is so valuable is that it is fundamentally not correlated to the other 99. And just on the off chance that all the people that manage the 99 may not totally know what they're doing, the $1 may actually save us.
Here's Chamath Palihapitiya's Bitcoin forecast. Shaped by his early investment and keen market understanding, Chamath envisions Bitcoin reaching $100,000, then $200,000, and eventually $1 million per coin in the next 2 decades. Despite the optimistic outlook, these predictions are rooted in a comprehensive analysis of the current economic landscape and the changing dynamics of digital currencies. Chamath's insights into the potential Federal Reserve soft landing and its impact on riskier assets, such as Bitcoin and growth stocks, offer valuable considerations for both investors and enthusiasts. Hope you found today's video valuable. See you in the next one, and all the best.